Hello, I'm Hickey from Interest.co.nz and welcome to a special Roost Home Loan Affordability Report. Every month we put together a home loan affordability report in association with Roost, the mortgage brokers, where we look at the affordability of a home loan in various different areas and using various different criteria. Essentially, we're trying to work out the combination of the cost of interest rates, house prices and people's incomes, and work out the proportion of your after-tax income you need to service a mortgage. And when you look at this month's Roost Home Loan Affordability Report, you see a slight deterioration in home loan affordability. That's mainly because of a higher median house price across the country. However, interest rates remain low, at record lows, and actually there's a suggestion now they may be falling. Let's look at home loan affordability in a couple of ways. Firstly, the single median income buying a median priced house. And with floating mortgage rates, this is what most people are on now, it currently costs 52% of your after-tax income to afford a median priced house on a single median income. That's up from 51.8% in September. Let's look now at a first home buyer household. This is where you have two young people earning the median wage for young people who can afford to buy a first quartile house. That means one of the cheaper houses. The cost for them is, in October, 21.6% of their after-tax income. So that's pretty affordable. Remember though, with these interest rates down here at around about 5.5% to 6% for floating and some of the short-term fixed rates, that 21.6% is up from about 20.6% in the last month, again because of these shift up in prices. However, it's near the best it's been in 7 years, and overall home loan affordability is around its best levels in 8 years. It all depends, of course, on the interest rate outlook and the outlook for house prices. Let's look first at interest rates. In the last couple of months, the situation around the global economy has really deteriorated. That's because of some big problems in the European currency zone and in the European economy. There are real concerns about sovereign debt, government debt in Europe, and how that might affect global economic growth. Now that affects China, which of course is our second largest trading partner and Australia's largest trading partner. And if this contagion of fear about debt spreads to America, which is the world's largest economy, that could affect the global environment for the economy and therefore eventually affect us through potentially lower commodity prices, lower export returns, and slower growth generally. Now, it's worth looking at the growth outlook globally and locally because that's how the Reserve Bank looks at the outlook for inflation. Remember, lots of growth, quite a bit of inflation, and the Reserve Bank has to put up interest rates to control that inflation. At the moment, the outlook for growth is pretty weak, which means the outlook for inflation is weak. And up until a few months ago, people were thinking the Reserve Bank would have to put up the official cash rate, probably towards the end of this year, early next year, to control inflation as the economy starts to recover. But in the last couple of months, this deterioration in the outlook for interest rates and the economy means some people are even now saying the Reserve Bank could cut the official cash rate in the next few months. In fact, that's what the financial markets are saying. They're pricing in a cut, can you believe it, over the next year of around about 20 basis points. Now, economists who are not quite so flighty as those in the markets, they still think the Reserve Bank will hold the official cash rate at 2.5% until the middle of next year. But as the dark clouds gather over Europe, that view is beginning to change, particularly because New Zealand's economic outlook is tied to what's happening in Australia and things are slowing down there. Remember, they cut their official cash rate back at the beginning of November. So overall, this means the outlook for interest rates is that they stay low for longer and potentially now they could be cut. Now all of this means that there's reasonably robust demand for housing, particularly in those areas with a shortage of supply. And in central Auckland, those areas with more expensive houses, we're starting to see prices rise, and in some very limited areas at quite substantial rates. This is now beginning to spread in some parts of the country. We're starting to see prices warm up a little bit. Of course, we're not back to the boom levels of 2005, 6, 7, but volumes are certainly up, of house sales up by about 20 to 30% from a year ago. So let's wrap up then. When you look at home loan affordability, it's deteriorated slightly in October from September, but it's near the best levels in either 7 or 8 years, depending on who you are. And that's because of record low interest rates. Interest rates are likely to stay lower for longer and may even fall further. And house prices look reasonably stable and in some areas are actually starting to rise. The big question though is if the global economic outlook starts to deteriorate significantly and growth slows here, unemployment rises, you might not see that strength in house prices follow through. I'm Bernard Hickey. That was a special report on home loan affordability brought to you in association with Roost.